Hi everyone, I am Karan and welcome to Karan's Gyan. Today I'm going to talk about Max Healthcare's listing. As you know, today Max Healthcare got listed. By today I mean 21st of August, and it left many of us wondering how did Max Healthcare get listed on the market without an IPO. So I'd explain the reason behind this listing, but before delving into how this listing happened and the technical jargons behind it, let us understand the share price of Max Health. Like I said, Max Health got listed today, and it seems there are no sellers of Max Health. We can see there is huge bidding amount at 111 rupees 75 paisa, whereas no one is offering to sell it. As of now, at NSE, Max Health is trading at 111 rupees 75 paisa, 43 rupees up, or about 62% up. So it just skyrocketed on the day of listing. And well, the reason behind this would be in this video, so please stay tuned and watch this video till the end, and you would agree with the investors who are not willing to sell this share. Now, understanding the listing of Max Healthcare. So, Max Healthcare was listed into the market because it is a demerged entity of a already listed share. So, Max India was basically a share that is the parent share of Max Healthcare. Max India said that it would demerge and it suspended trading on 12th of June 2020. It demerged into two businesses in its healthcare business and a non-healthcare business named Advaita. So this new share is basically Max Healthcare, which is the demerged entity of a already listed share. So when a demerged entity of a listed share comes into the market, it need not file a red herring prospectus, which is essential for filing an IPO. So it basically means it doesn't have to come up with an IPO. Now, this business, the non-healthcare business called Advaita, it would come up in the market again in the coming few weeks as maybe Max India, but I'm not too sure about it. Talking about the share swap agreement, so what happened here is if you had 100 shares of Max India before the trading was suspended, you would end up with 99 shares of Max Healthcare of face value 10. However, in Advaita, you would end up with 20 shares of Advaita of face value 10. So this is how the demerger has taken place, and this is how shares are being allotted on the basis of a share entitlement basis. Now, talking about MHIL. So, MHIL is Max Healthcare India Limited, and it doesn't just comprise of the demerged entity of Max India. It is a little complex to explain, but please hold on, you would understand everything. So, what has happened is first, Max India has demerged its healthcare business into a new listed entity, which is Max Healthcare, like I said. Now, this new entity is actually merged with the demerged entity of Radiant. So, what has happened is there's a group called Radiant. It is just like Max India, it doesn't only have one business, it has many businesses. So, what Radiant has done is it has demerged its healthcare business just like Max India, and it has combined or merged the healthcare business with Max Healthcare. So, do you understand what I'm telling you? Demerger of healthcare business of Max India into listed entity, then demerger of healthcare business of Radiant, which is the other entity, into MHIL. So, the healthcare business of Radiant is merged into MHIL, and as a result, MHIL is formed. So, in this case, if I look at the promoters here are basically KKR, Abhay Soi, that's all. So these two are the main promoters, whereas public has 17.8% stake and Max would have 7% stake. I would get to it. Like you can see, Max Healthcare has merged with demerged entity healthcare business of Radiant and formed Max Healthcare India Limited. So I would explain you a little more in detail. I know it can be confusing. Like I said, Max India had three businesses: Max Healthcare, which has now formed MHIL, Max Bupa, and Antara Senior Living. Now, the 0.6% is the other residual business of Max India that has been combined with Max Healthcare, and this Max Healthcare has been combined with the demerged healthcare business of Radiant. So this is how it looks like. The promoters of Radiant were already KKR Group. KKR is a private entity group, and Abhay Soi was also promoter of Radiant. So now talking about the new merged agreement. So what has happened here is there is a leverage buyout. Now, leverage buyout is hard to explain, but what I can tell you by leverage buyout is a smaller company has bought a bigger company. In this case, Radiant Life Care or Radiant Group is the smaller company. Radiant Group has only two hospitals, BLK Hospital or BL Kapoor Hospital in Delhi and Nanavati Hospital in Mumbai. Of course, you would have heard this name, Nanavati Hospital. Amitabh Bachchan, after being diagnosed with coronavirus, he ended up in Nanavati Hospital. Whereas Max Healthcare is a big entity, it had 2,400 beds and 11 hospitals in Delhi NCR. So we can see the sheer difference between size. So basically, KKR being a private entity, a private equity player, it's a huge player. I would explain you about the promoter later. So it has taken up leverage and it has acquired MHIL along with Abhay Soi, who is the CEO of Radiant Group. So these two entities have merged and they are among the top three hospital operators in India, and they're a stronger player in Delhi NCR because 11 Max Healthcare hospitals have combined with one hospital, BLK Hospital in Delhi. If I talk about key financials, uh, for financial year 2019, net revenue from Max was about 1300 crores, while Radiant Life Care was 444 crores. We can see a lot of figures. They have given occupancy, number of doctors, number of employees, and so on and so forth. What we can basically understand is the merged entity is bigger and stronger. They have a stronger occupancy, they have more doctors, more employees. And if I look at debt, Radiant Life Care is actually a company with has lower debt, whereas Max Healthcare has higher debt. So again, this plays a role of coupling where lower debt and higher debt companies are integrating. Looking at the merger in a broader way, so 14 hospitals are being combined with two hospitals. One has a deeper network in Delhi NCR and North India, whereas the other has a network in both NCR and Mumbai. Talking about the effective cost management, Max has higher gross margin with better variable cost management. Whereas if I talk about Radiant Group, it has higher earnings before interest, tax, depreciation, amortization margin with better fixed cost management. So one has a better variable cost management and one has a better fixed cost management, which shows it has best of both worlds. Talking about balance sheet, Max India has a stretched balance sheet. By stretched balance sheet is it has a lot more debt than Radiant, which has lower leverage. Lower leverage would mean lesser debt. Now if I talk about the complementary managerial skill sets, so Max Healthcare has strong systems and processes, whereas Radiant Group is actually a promoter-led operations with turnaround capability. So Radiant Group was actually failing, and when Abhay Soi, one of the promoters of Radiant Group, joined the company, he was a restructuring expert in healthcare. He had worked with Ernst and Young and KPMG in the past, and he has a turnaround legacy in which he has used innovative asset light operating and management systems. And if I talk about the two hospitals with which the company has, BL Kapoor Hospital and Mumbai's Nanavati Hospital, they both were struggling, and this guy put a turnaround story, Mr. Abhay Soi. He put a turnaround story in these companies. Now, talking about KKR. So, KKR is the solid part of this deal. Like I said, I showed you um, the shareholding. So, the new shareholding of the merged entity is KKR would have 51.9% stake. As of now, it has only 46.9% stake, but it'll acquire additional 5% from Max promoters. And Abhay Soi has 23.2% stake. Max promoters and public don't have a good stake, controlling stake, as I would say. So basically, KKR and Abhay Soi are controlling the company as of now. Talking about KKR, KKR is the world's fifth largest private equity firm with $218 billion in investments. If I talk about India, they're relatively new in India, but they are known as a turnaround company. They have turned around a lot of companies based in Europe and US, and they have investments in Bharti Airtel, Avendus Capital, and Integrate. So Integrate is basically an investment trust, just like Mindspace is an REIT, real estate investment trust. Integrate is basically an infrastructure investment trust. So it has considerably good investments in India. It is a good private player. It is a private equity firm with $218 billion in investments. It has the management of Abhay Soi, who's a restructuring expert in healthcare. So it seems that both these players, they can turn around this company and maybe make it the leader in the market segment. So my recommendation for you is you should acquire Max Healthcare if you're able to get your hands on the shares. And Max Healthcare looks a good share to me because of its promoters. It is mainly because of the promoters. I'm telling you, Abhay Soi can do wonders. After I've read about him, I didn't read about Abhay Soi before, but from what I've read about him, he can do wonders. If I look at what he has done with BL Kapoor Hospital and Nanavati hospitals. So again, my rating is buy, acquire Max Healthcare, and I'm sure it'll give you good returns in a time frame of 2 to 3 years, and in fact it is a good long term bet too. So guys, this is my take on Max Healthcare, and I hope you like my video and my research. Please subscribe to my channel. Thank you very much and have a nice day.